It is brought to you by the AI Native Banking and Fintech Conference, happening in Salt Lake City on September 30. This event, hosted by Spring Labs and in its second year, is all about practical applications of AI that are in production at banks today. There'll be no hype, no fluff at this event, just real-world use cases for banks and fintechs. Join the more than 400 people who will be learning about AI solutions they can purchase today. There'll be big-name keynotes, panels of bankers comparing notes, case studies, and demos from some of the cutting-edge AI companies. Use the coupon code PODCAST20 to receive 20% off your ticket at conference.springlabs.com.
The key that we learned in the offline, in the brick and mortar, in order to succeed, it's not enough to have a great product. This is a prerequisite. But in order to succeed, you need a great product. You need, of course, the finance to make sure that the underwriting works well, but you also need a retail DNA in order to do it and to bring the technology into it. In the last 20 minutes, I talked a lot about this associate that works for Toyota, but actually presents the offer for the customer for Sunbit. This associate is a key in our ability to deliver the product, and we approach this associate with technology, with AI, with gamification, in addition to everything else.
This is the Fintech One-on-One podcast, the show for fintech enthusiasts looking to better understand the leaders shaping fintech and banking today. My name is Peter Renton, and since 2013, I've been conducting in-depth interviews with fintech founders and banking executives. Today on the show, I am delighted to welcome back Arad Levertov, the CEO and co-founder of Sunbit. Now, I last had Arad on the show back in 2019, and needless to say, a lot has changed at Sunbit since then. We delve into their innovative approach to consumer finance, highlighting their success in offline BNPL, deeply penetrating verticals such as auto repair and dental services. We explore how Sunbit is able to approve 90% of their borrower applications while enjoying a low single-digit default rate. It seems impossible, but once you learn their unique approach, you begin to understand the method that results in such stunning metrics. Now let's get on with the show. Welcome back to the podcast, Arad.
Thank you, Peter. Great to be here.
Okay, well, it's been a few years. 2019 was the last time I've had you on. So in the 6 years, a lot has happened, I know, but maybe you could just tell us some of the highlights of Sunbit's journey over the last 6 years.
First of all, a lot has happened in the world, 20
Yes.
years. Oh my God.
For sure.
A lot happened in the world, and also a lot happened for Sunbit, which is great. When we started Sunbit, we said that we're going to bring technology and machine learning and AI to build a financial services company that is focused on the consumer, with the consumer and the customer in the center. And we started with the buy now, pay later product and with the vertical of car dealership. I think when we talked in 2019, we were getting into the car dealership. We had about 2,000 locations, maybe a few hundred of thousands of customers that used the product with Sunbit. And looking today, we have multiple products. We have a buy now, pay later that is active in nearly 30,000 locations in different verticals like car dealerships, repair, dental, eyewear, vet. We have embedded finance. We also have a credit card product that is in the hands of hundreds of thousands of customers and that you can use Sunbit anywhere. With all this, while we were growing, serving more than 4.5 million customers, always remember that behind these huge numbers, there are great customers and we never charge any fees. And remember our mission to do it. So keep growing, but not forgetting why we started actually back in 2016, what we want to do.
Right. And it's still, you're remaining purely in the offline space. Is that correct? Like you're focusing on some of like the brick and mortar companies and healthcare and that sort of thing?
Correct. So our go-to-market starts with B2B2C from the offline space. This is our DNA. But then when the customer gets the loan and work with us, then she can get a credit card and can buy anywhere with it. But yes, the approach is to go to the offline space. And the idea was that this is huge market, much harder to disrupt because you actually need to figure out a great technology to get to the own offline space, and to be there and to work with stores and to leverage everything that you can do from the technology on the e-commerce into the offline space. But once you do it, it sticks, it works well, and customers appreciate it and stick with you.
Right. And so what are the primary verticals you're working in the offline space?
So our buy now, pay later started, as I mentioned, with car repair dealerships.
Yep.
And today we are in more than 60% of this market.
Wow.
There are 17,000 locations where you can fix your car in the authorized dealership. And we are in nearly 10,000 of them. And we have partnered with all the top 25 groups like AutoNation, Osbury, Group One, all of them, we partner with them. We have endorsement by the 15 or even 17 OEMs that actually push us into their dealerships. This is the first vertical. The second vertical is dental, which is interesting. Dental, we're actually in more locations. We are in nearly 14,000 locations in dentistry. However, there are nearly 200,000 dental offices in the country. Like my son used to say, we have more teeth in the families than cars. So it's bigger, he's huge. And then we also have penetration into vet, into eyewear. And we also work with companies like Stripe to get embedded finance into additional verticals like car services, which are small locations, med spa, and others.
Okay, interesting. I'd like you to run through for the listeners the process when someone's at a dentist or an auto dealership and suddenly they realize that that's $1,000 or more, and what's the process like at this offline location?
I will say it, but if it's okay with you, I will actually start even before that.
Okay, sure.
And what we did from day one is to use data and machine learning and AI to decide which office and which vertical we're going to work with.
Okay.
And also how we incentivize the person in the office, the one that offers the service to the customer, to offer Sunbit. And that's even before the customer applied.
Right.
We would tell, let's say Peter works for a car dealership as a service advisor. And we will tell Peter, you have a great tool, which I'm going to describe in a second, that within seconds, you can approve 9 out of 10 people that apply to, and they will never get any fees and they will get personal rates. And by the way, Peter, as a service advisor, if you help a customer, you're going to get points and you're going to have gamification and you're going to, be a hero and be number one in the country of helping customers. So this is even before the customer applied. Mm-hmm. And then, so Peter was trained. We decided to choose the dealership because we know the customer will come back and we have some relationship with Peter. And now when the customer comes, the process is super, super fast. What we ask for the service advisor or for the people that works in the dental office, and we have about 150,000 associate that not work for Sunbit, but are in the system, to show the customer the ability to pay over time. And we tell they tell the customer, you need to fix your car for $1,000, but don't worry, we have ability to get the service now and pay over time. What they need from you is only the driver license. Scan the driver license. We basically scan the barcode at the back of the driver license. And then within seconds, you can see if you can get like 3, 6, or 12 months, or maybe up to actually 48 months of splitting your payments. So within seconds, we basically allow the customer to see how they can pay for the either unexpected or unexpected repair. I would say that all the offers are personalized, which means one customer will get a different offer than others. We have many tiers. Each customer will get a better offer compared to what she has in her pocket, which means if you, Peter, is a prime customer, you will definitely get a 0% and you will not have to pay anything, which is better than what you pay for the credit card. If I am a subprime customer, I will get an offer which other traditional lender will not offer me. The offer will be much better than even a payday loan, of course. So within 30 seconds, we approve 9 out of 10 people, and each customer get a best offer. So the customer gets, scan the driver license, see the option, choose whatever he or she wants, complete the transaction, get back to her life.
Okay, well, there's quite a bit to unpack there, but the first thing I want to focus on is this 9 out of 10 approval rate. I mean, 90%, that's unheard of in the unsecured consumer lending space. How are you able to have such a high approval rate? I presume you're working with different lenders with different credit risk appetites on the back end, but tell us a little bit about that.
So I would say that we take all the risks. I would say before I would say that how we do it, I will say that we never charge any fees. So no late fees. We do not go above the user rate, which means we don't charge more than the consumer lenders are charging. And we are the lender. We work with the bank, but we take all the risk. And how are we doing it? It actually starts, and that's a little bit counterintuitive to explain, it starts before the customer even apply. We use artificial intelligence across the system. So if the associate that works in the dealership knows that there is a great product that will be approving every customer, this associate will offer it to more customers. If the offer is more personal, which means if a prime customer will get a good offer and a subprime customer will get a good offer, which by the way takes 30 seconds, more customer will be willing to apply. And then this, before even I did the underwriting, gets Sunbit more customer that actually is more like a normal distribution. So you get more good customer that join you, and then it helps you to approve more that riskier customer. And that's how we do it. And we use AI across the system. We personalize the offer. We adjust the down payment. We adjust the amount. We adjust, of course, the APR. We adjust the risk that we give. And it works. We did it more than 4.5 million times. We have great credit facilities. We just did a great securitization deal with the AA rating, which means the great performance are there. And when we started, people ask us how we do it. I always try to explain that it's not only the underwriting, it's actually looking at the entire process and using data from choosing your partner, incentivize your associate, treating your customers well, because once you treat the customer well at the end, they will come back and use us again. And actually, almost 40% of our loans coming from repeat customers. And all this get us into a great position that allows us not only to keep growing at the 35% year over year, but also to be profitable, GAAP profitable, without any adjustment.
The 10% that you're declining, are they deep subprime? Are there problems with identity verification? I mean, what is the reason that you would decline someone?
So these are really the edge of, as you mentioned, sometimes we are, and really rare, right? There is some problem with identification, some risk of fraud, and we use a lot of technology to identify it. And this is kind of really the edge cases. In some cases, by the way, we have programs that we call it approve all, which we approve actually 97%. So only when there is a really problem on identification, we don't do it. But the idea is really to try to give every customer a great offer, a great rate, and we take the risk on us. Like if the customer doesn't pay, we don't make any money from it. We actually blame ourselves and do better job to make sure that we make money.
Right. Well, that's going to happen, obviously, when you're in doing these loans. I mean, can you share what default rate is your portfolio is receiving?
Yeah, I think, you see that the rating that we got and the raise that we got into securitization that we just did a few months ago, and you see that we have great performance. The default rate, it varies, of course, on the vertical, but it's low single digit, and this is great. We adjust the amount, we adjust the down payment, we adjust we adjust everything, right? Of course, that a subprime customer, if two customers, one is a subprime and one is a prime customer, will want to fix the car, each one of them for $1,000. One will get a lower down payment than the other, and we'll make sure that every customer will be able to pay. And usually the loan amount is small. So a subprime customer can make a $50 monthly payment. We want to make sure that this customer would prioritize the payment to you, to Sunbit, and we use data to predict this customer behavior. We call it, it's not a willingness to, it's not ability to pay all the time. Sometimes it's what we call willingness to pay, and therefore we try to predict the behavior of the customer by using the artificial intelligence.
Right, okay.
I can give you one example. A simple example, right? So let's say there is actually a prime customer with a 700 FICO score, and you look at the data, you look at the file, and it looks that this customer pays for the mortgage and pays for the auto loan, but this customer is late for a mobile, mobile phone, the AT&T phone for like $50. You see there is something that doesn't make sense for this customer. There is like something irrational with this customer. Why would you risk your credit for $50? It may not hurt the FICO score so much because they have some other stuff, but this kind of means there is something irrational. So we would approve this customer, but maybe charge a higher down payment to make sure that these customers really want to take the loan with us. So we look at these things and we try to make the best decision. And as I mentioned, the decision actually starts even before the customer actually applied. With the vertical we went, and with the associate that actually worked on it.
Right. And so that brings up my next question. Like, how are you approving say there's a, in the auto repair, there's a lot of mom and pop, operations, right? Small companies like, maybe 3 to 5 employees and operating in a relatively small town. How do you decide who to approve to come onto your platform?
That's a great question. We use data, and I'll give you an example. In the auto dealership, it's we usually work with the authorized dealership. So it actually, when you need the authorized dealership, Toyota, Honda, that means it's more than this. But I give you an example, the dentist, right? As I mentioned, there are 200,000 dental offices in the country, and some of them is a dentist office that actually the doctor comes every day, 5 times to the office. In some cases, the doctor would come only 2 times to the office, and the rest of the 5 days will be maybe only smaller service or different service. We take all this into account when we kind of analyze how much to invest in each merchant. So, for example, for the dentist that comes 5 times, we estimate there are many customers. We may actually fly a person to train the staff over there to make sure they are all equipped to help all their patients. For the dentist that maybe use only, with the office that actually the dentist comes once a week, and the rest is something that is small procedures, we may do a Zoom call or maybe do online training, or AI training. We'll send them AI video, and they will be trained by AI. So we manage the cost of how much we invest in each merchant. And then this is only the beginning. Then we continue to work with the merchant based on the tiers and continue the relationship. So that's how we use the data to make sure that, help us to what we call the CAC to LTV, how much to invest in each merchant and how much this merchant can produce to themselves and also to us.
What's your business model? How are you I mean, are you taking an origination fee on the loan, or are you making a spread on the interest? I mean, how are you making money?
So I said no fees.
Yeah, I know you said no fees. I knew you were going to say that.
No origination, no late fees. 35 to 40% of our loans are actually 0%, doesn't add any cost to the customer. So how do we make money? And we are making money. As I said, we are probably approaching $400 million in revenue run rate, and we are profitable, GAAP profitable. So we make about close to half of our money from the merchant. So for the merchant is paying us a fee for helping them to close the transaction. So for a $1,000 transaction for car repair, we, let's say, will transfer the merchant the next day, because we take the risk. Let's call it 950, and this number varies by vertical. So we could pay 950, and even if the customer doesn't pay anything, but just gives us the money back, we basically made $50 in this example. The other thing is the merchants are paying us also monthly fee that allows us to invest in the training and work with them, just subscription fee to do it. And for the customers who actually take the loan and pay interest, we would charge interest and make money from the spread. But no fees, no late fees, no origination fees, annual, nothing. That's what we do. And this is with the buy now, pay later. Then we have the credit card product, which we offer to our customers as a second product, or with partners of co-branded card when we make the interchange and also the interest spread.
Yeah. Okay.
Again, no fees.
Right. Yeah, that makes sense. And understood. Okay. So as you're growing, is this a one-by-one type deal when you're adding merchants? It seems like that would be slow and expensive, and you've grown quite fast since we've last spoken. What's your approach to, I guess, go to market on the merchant side?
So it's again, this is where data, AI tells us where to go. There are some verticals that it's actually worth to add one by one. That's okay. Mostly in the car dealerships. And we started with just knocking on doors. And then once you knock on doors, you go to Honda and you tell them, Honda, help me to get to all your 1,000 dealerships in the nation. And then it helps. There are some merchants and some verticals that you need to work with partnerships in embedded finance to go faster. This is mostly, as you mentioned, smaller verticals like med spa, when the store is smaller, veterinarian, some home improvements that are home services. Over there, we do partner with SaaS platforms that provide services for these merchants, and then Sunbit becomes a payment option on their system. So in this case, we don't have to send a salesperson. Of course, the margin is different because everybody needs to get a cut, but it doesn't change the story of focusing on the customer, providing the customer a great solution, and providing the merchants more sales. So it depends on verticals. That's what I'm saying, and I said it a few times, is that we use the data and the AI to look from all the way to how to get to the merchant to how we serve the customers, which we do all the service in-house internally.
You mentioned Stripe before, and I want to dig into that a little bit. What's your partnership with Stripe? What's that look like? How are you adding new customers that way?
So Stripe is part of the embedded finance strategy that we've developed over the last probably 3 to 4 years. And the idea is exactly based on your previous question: how do we help more merchants without sending person after person after person?
Right.
And what Stripe enables us is, Stripe is a payment processing that works with a lot of SaaS platforms that service merchants across the nation. And our partnership with Stripe allows those SaaS platforms to offer actually buy now, pay later when they offer Stripe. So with Stripe, we actually partner with a company, for example, called Shop Monkey, that service a lot of small mom and pop shop on the car repair. And with Sunbit, with Sunbit and Stripe, they were able to just turn on the ability for these mom and pop shops to offer buy now, pay later. So again, this allows us to go to many locations that probably smaller, and we don't have to send a salesperson in person to sell to them.
Gotcha. And what about checkout.com? Because I think of checkout.com more as in the online space. What are you doing with them?
So checkout.com is a great partnership for us. Actually, it's more on our operation. When we collect the money from customers, we use a lot of the debit card of the customer, because remember what we try when I describe you the process that takes place in the store. We want to make it smooth and fast and feels like the customer only swipe a card on the machine. So a lot of time the end customer uses the debit card to pay the down payment and pay the monthly payment. So we use checkout.com to collect it and to optimize it, reduce our cost, that we can pass the savings back to the consumer.
Right. Gotcha. Okay, so I want to talk about your competitive moat, because you've built something that is not going to be easy to for a new competitor to come in head to head. You've got the distribution moat, and you've also talked about the data. So you've got and all of the AI that you're doing. You've got the technological moat. So maybe you could just talk a little bit more about, when you think about the competitive market, how do you view the moat you've built, and how do you sort of view the overall, particularly in the BNPL space, it's a big space, but it's also competitive. How do you view the moat you've built?
So first of all, it's a big space, but the financial services and consumer finance is a huge space, right? I mean, the market is just getting started. We in the fintech space talk about buy now, pay later, but when you look at credit card spend and just in general consumer spend, it's just a fraction of this space. So we are just getting started. For many years, lenders had kind of this approach of if you want good performance, you need to increase APR. If you want great return, you need to decline more customers. What we were able to do is to do the other way. We can get great performance, we can do it with lower APRs, and we can do it without any fees. And the way we do it, it's not only in the underwriting, but it's the entire ecosystem that works with with approaching the merchant, training the people, having great capital markets behind us, and of course, amazing underwriting and personalized offers. And it started also with go-to-market. So the key that we learned in the offline, in the brick and mortar, in order to succeed, it's not enough to have a great product. This is a prerequisite. But in order to succeed, you need a great product. You need, of course, the finance to make sure that the underwriting works well, but you also need a retail DNA in order to do it. And to bring the technology into it. In the last 20 minutes, I talked a lot about this associate that works for Toyota, but actually presents the offer for the customer for Sunbit. This associate is a key in our ability to deliver the product. And we approach this associate with technology, with AI, with gamification, in addition to everything else. So I would say that the moat is not only in the location that we are, but also with the relationship that we have with the merchants, with the associate, with the customers that love Sunbit and take Sunbit again and again and again. And overall, with the reputation we are building with the customers. We have net promoter score in the high 80s. As I mentioned, we have over 30 to 40% of repeat customer users again. Once you fix your car with Sunbit, you're going to continue fixing your car with Sunbit. And unfortunately, there are no shortcuts. But if you do it day after day after day, and customer like you, and not only they will use you again, they will also prioritize the payment to you, and they will not switch for you. So
right.
We see it in the car dealership. We're already 60% of the market. We're going to see it in more and more verticals.
So what we haven't talked about yet is collections, and to have low single-digit default rate while approving 90% of customers coming in the door, and obviously, different terms for those customers, but still, the collections piece has to be critical. What are you doing there that's different?
So we start with the fact that, as I said, we do not charge late fee. It starts with the underwriting. It starts with the way we choose the merchant. It starts with the amount that we get. And let me explain how this works. A lot of customers, especially on the subprime, the monthly payment is maybe $40 or $50.
Right.
Because again, we reduce the risk, so we lower the monthly payment. And nobody wants to get in trouble. And I say get in trouble means reporting to the credit bureau for $30 or $40. So what we do in the collection, and we use data, we use technology, we send email, of course, phone, but we basically help the customer not to get into problems with the credit bureau. So we use all the technology and the approach to do it, and we do it all in-house. And we have the data loop between the call center in Vegas, which is US-based, to the sales team. If we see some more complaints or high collection from one merchant to another, we go back to them and train them. So we use this loop of data from the beginning to the end to make sure that the performance are good.
Okay, that's interesting. So last question then, as you're looking forward here, there's obviously lots and lots of verticals you could go into, but what are your expansion plans for the next 2 to 3 years?
I will start with the future. In many industries, technology already changed the way the industry works. We're doing right now a Zoom discussion, which couldn't have been the case 20 years ago. We read media differently. But in financial services, especially consumer finance, still it stays the same. Like the statement of the credit card that you have in your pocket is the same statement that was like 30, 40 years ago, which means it's not personalized. It's focused on the company instead of the customer, which is hidden fees and high fees. And this will not be the case, 20 years from now. It will be personalized. It will be focused on the consumer just because it will get there. And we want to be there, one of the leading companies that does it. The way we do it by focusing on the customer and taking different approach of go-to-market and definitely using AI across the entire operation. We started with the car repair, going to healthcare right now, and healthcare is a huge opportunity, doing embedded finance, but keep developing more products for consumers, not only buy now, pay later, to help them manage their life in a better way. So if I think in the coming few years, huge opportunity in healthcare, huge opportunity in car repair, unbelievable opportunity in embedded finance, in addition to more products. As I said, we have a credit card. We're launching another credit card. We're going to have more product for the consumer after the use Sunbit to manage their life better.
Okay, well, we'll have to leave it there, Arad. Really great to chat with you again. Congratulations on the success you've had over the last few years, and best of luck in the future.
Thank you. Great talking to you. Great seeing you again. Listen to all your podcasts. Thank you, Peter.
Okay, thanks, Arad. See ya. I thought it was interesting that Arad continued to mention the people on the front lines of his business, the person at the auto repair shop or dentist office who is helping their customer with financing. To achieve their touted 90% approval rates and low single-digit default rates, you need everything working in unison. The underwriting has to be spot on. Your data collection and identity verification needs to be flawless. And the person dealing with the customer has to understand what you're trying to do so you can get a positive selection bias. I have a feeling that the human element might be the key to such great numbers. Anyway, that's it for today's show. If you enjoy these episodes, please go ahead and subscribe, tell a friend, or leave a review. And thanks so much for listening.